Welcome to Research Recap on JP Morgan's Making Sense podcast channel. I'm Phoebe White, head of U.S. inflation market strategy at JP Morgan, and today I'm joined by Mike Feroli, our chief U.S. economist, and we're here to discuss takeaways from the July U.S. employment report as well as the path ahead for the economy and the Fed. Mike, thanks so much for joining.
Good to be here.
So, Mike, we have a lot to talk about today, but why don't you just kick it off with some high-level takeaways from this morning's report?
Yeah, so it was obviously a soft report. We had the unemployment rate increase 0.2 to 4.3%. That comes after 3 consecutive increases the prior 3 months. The average work week ticked down. Average hourly earnings growth slowed to only 0.2. So pretty much across the board, it wasn't a terrible report, but it was definitely softer.
So we knew this had the potential to be a messy report due to weather effects, Hurricane Beryl, but BLS did come out and say that hurricane probably did not have any impact. Is there anything that sticks out to you that could have been distorted by weather?
So there could still be some weather effect, right? There was definitely a big increase in people who were on temporary layoff, which would be consistent with a weather effect. That being said, usually when you have a big weather effect, it kind of biases average hourly earnings growth upward. And this month we got actually a downward surprise to average hourly earnings growth. So you can't say no effect, but it doesn't seem to be the only thing going on in this report.
Okay, so let's talk about what is going on in this report. So I think there's been a lot of debate recently about how much signal to take from the move up in the unemployment rate, whether it was largely driven by increase in supply, labor supply specifically, or whether there was real weakening in labor demand. So maybe can you just touch on the supply side first, anything that sticks out in terms of participation rate and supply factors?
So the participation rate did increase to 62.7%. It had fallen earlier in the year, and now it recouped that earlier loss. So that's certainly good news. It doesn't seem to be the only thing explaining the move up in the unemployment rate, because the numerator in the unemployment rate, number of unemployed people, did increase. And so that doesn't seem to be all new entrants. I would say on labor demand, we probably get more of the signal from the establishment survey, where, as mentioned, not only did job growth slow, but you had a decline in the average work week. So it does look like labor demand is also showing signs of weakening.
And where, I guess, sectorally do you see that? I think we've had a move down in the diffusion index. Is it fairly widespread?
Fairly widespread, right? You had most of your job gains concentrated in construction, healthcare, and government. And we suspect construction employment will roll over later in the year, as we've seen the number of homes under construction has peaked and is now moving down.
So how do you square, I guess, some of this data, which seems to imply that, maybe high policy rates are, starting to eat at the economy, and yet we've had fairly strong growth data recently. So how do you sort of square those things?
Yeah, so I think what we're seeing here is, again, some of the lagged effects of higher rates, certainly on labor demand, right? And it seems like business activity is softening, even though we did, as you point out, have a decent GDP report for the second quarter. The overall broad sweep of the data, to us looks like it's softening, particularly when you take account of things like jobless claims and continuing claims and things of that nature.
Okay, so right now in your forecast, you have growth momentum continuing to slow as we head into the second half. How would you think about risks to the growth forecast in the second half?
Yeah, so we have 1% growth in the second half. Risks are starting to feel like maybe they're tilting a little to the downside. Before they had been, we thought, tilted to the upside. So we're not changing anything just yet, but it does feel like we may be losing a little momentum as we go into the end of the summer.
Okay, let's talk about what this means for the Fed. We did just have a meeting this week where, the Fed left rates on hold, but seemed to clearly signal a cut in September. Seems like that's now a given, maybe more a question about pace. So how are you thinking about the Fed from here?
Yeah, so we do think the Fed probably picks up the pace or starts big, if for no other reason than, when we look back at Wednesday, what was really the most notable development was that the committee decided that the risks to their mandate were basically in balance. The risk to either higher inflation or weaker job market. I think this reinforces that sense that they're in balance and that there are risks to the employment side of the mandate. So if your risks are in balance, you probably want to have a policy setting closer to neutral, which is, at the highest, maybe 4%. So we think they have a lot of room to catch up to where they should be, right? So you're at 5.5% now. So that's a 150 basis point gap. So I think they'd probably want to close that gap pretty soon. So we do think they start with 50 basis point cut in September and follow that up by a similar size move in November.
And then once they get closer to that 4 to 4.5 level, how do you think about speed from there? And I guess just from a risk management perspective, is speed more important, or is it kind of waiting to see how the data come in?
Yeah. So I think after you get closer to the 4% range, you can probably slow down a little bit and feel your way from there. We do think they would probably continue easing after that, but we see them slowing to a 25 basis point pace of rate cuts beyond that.
Okay, so that's starting to feel like what markets are starting to expect. We have rates markets pricing about 43 basis points of cuts in September. At the time of this recording, midday on Friday, August 2nd, we've seen a big move in 10-year yields. We're down about 40 basis points on the week. We're trading close to 382 in 10s. The broad curve on the week is about 18 basis points steeper. But, rates markets are still priced for the Fed funds rate only getting down to just under 3%. If you're right and things are starting to get on a track of further weakening, and we're in store for, a continued pace of 25 basis points per meeting through the end of next year, that does imply that rates could fall even further from here. Mike, does that sound about right?
It does.
So with that, let me close. Mike, thanks so much for your time today. And thanks to our listeners for tuning in. We hope you join us next month. For more research insights, visit jpmorgan.com/research.
Thanks for listening to Research Recap. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. This communication is provided for information purposes only. Please read JP Morgan research reports related to its contents for more information, including important disclosures. Copyright 2023, JP Morgan Chase & Co., all rights reserved.